Good afternoon, everybody. Marty Mazora, January 12th, 2017, your weekly video. Last week, we looked at some of the titles of my entries in my January trends file. We stopped here with a good manufacturing report. Just to kind of jump around, the Institute for Supply Management Services survey beat expectations. Young people are piling into the workforce, so that speaks well about the economy going forward. Interesting phenomenon right now, lower credit quality stocks, companies that have suspect balance sheets and therefore suspect credit ratings have been outperforming higher credit quality stocks quite notably of late. Typically you see that in the earlier stages of recovery. Does this mean that we're ready to take off in a new leg in the bull market? Of course we don't know, but producer price indices pretty much throughout the world are actually rising along with rising global production or global industrial production. Analysts expect very good results from financials and energy and very poor results from healthcare and consumer staples. The S&P price to book ratio is at a 9-year high. We're going to talk in a minute about valuations. Europe's economy really is looking better. Mortgage apps starting the year off here in the US very strong, surprisingly to some because of higher interest rates, but some of the strongest numbers so far in the recovery. Small businesses showing the highest optimism in 12 years. That came from this week's NFIB survey. Huge risk in bonds, according to Barclays Aggregate Bond Duration Index. Advisor sentiment dropped a little bit last month, a little bit too high for comfort. If you look at where it sits relative to market action on a historical basis, I would suggest, though, that as sentiment is picking up, that's probably a bullish thing. It's that if it stays too high for too long, that it becomes problematic. Big jump in consumer credit here in the US in November, a huge jump in fact. So that'll be interesting to see what we get in Friday's retail sales number. Okay, so moving on, I promised you we'd talk a little bit today about valuations, and I once again borrowed the chart from Chris Civacco, and that's CIOVACCO. I want to spell that out for you because if you go to YouTube, you'll find his channel. He does what I think is an outstanding job of providing various technical pictures of the market. This weekend he talked about price to earnings ratio. In fact, I have had people approach me in terms of, our valuation's too high, isn't this problematic, we're at all-time highs and so forth. But when you talk about valuations, the most utilized metric has been the price earnings ratio. So this is a look at what the actual price earnings ratios have been over the previous 12 months. So right now, we have been living in this range between 20 and 26. And a lot of people would tell you that that can be problematic. That's historically high. In fact, if you look at prior peaks, when the credit bubble blew up, it was 21 to 24. Right before the tech bubble blew up, it was higher, 27 to 31. But 20 to 26 still feels high to people. The point that was made here is simply that price earnings ratios in and of themselves are not good metrics with which to time the market from. For example, here was the PE ratios right after the market meltdown in 2008. Now, they got very, very high because earnings just basically disappeared. So one could argue, well, yeah, that's at the depths of a big decline. You saw high PEs here, you saw it here, but what about as we've moved up and as basically earnings begin to come back? Are those not problematic PE ratios? They can be, but I think it's more about the market setup than it is where PEs happen to be at any given moment. In fact, here, if we look back coming out of the 80s and into the early 90s, as you can see, here was a period after a nice run up, then a correction. Looks a little familiar if you compare it to up here, where PEs happened to range between 20 and 26. And along the way, we had a range of 20 to 27. So historically speaking, the answer would be no, not all by itself. I think high PE ratios can be maybe something that when the market is ready to roll over, when the setup is not so good, that's just another weight on market and on market sentiment. At a time when maybe things are turning out of a consolidation box, as I've illustrated for you here, it just doesn't feel too problematic to me. I think when it's all said and done, and history is anything but conclusive that you need to panic about the market when PE ratios get that high. Okay, so to wrap things up, folks, I want to show you just two more charts and then let you go. This is my running chart of the major sectors relative to the S&P 500. So I just showed you in the beginning what I would say is some pretty optimistic sounding economic data. is the market, when we look at it sector by sector, is it supporting that? Now, this is a really short-term look. I've shown you in previous weeks a much longer-term look, but this is just year-to-date 2017, but I thought it might be instructive just to see how the year is beginning. And I would say it's a little bit mixed, not quite as definitive in terms of what the market's saying about the economy, but definitely still positive. I'll show you what I mean. Anything over 100 means that this sector is outperforming the S&P 500. This happens to be technology, so I drew a green line under that one because it's over 100. Surprisingly, perhaps, is that financials have just barely underperformed the S&P 500. I don't think we should be too surprised, and yes, I do think there's a lot of reasons to be optimistic about financials going forward. I do think there will be volatility, of course, and they had a huge run up after the election. So a little bit of give back here on a relative basis. This, by the way, does not mean that they're down. It just means they haven't performed quite as well as the S&P 500. Consumer discretionary, which the last time we looked at this, it was red. It has come bounding back. So this is speaking a little bit maybe about what I said earlier about consumer credit really picking up. Materials nicely to the positive, which we've talked about already. Energy underperforming, get some give back. Energy has also been a big winner post-election. It was a big winner last year. Typically is a strong place to be while we're in an inflationary part of the cycle, which we may be in right now. Commodities are up a bunch, the most, in fact, against the rest of the market. Industrials are outperforming the S&P slightly. Staples are not, which we've talked about we should expect this year. Of course, anything can happen. Utilities notably underperforming. Healthcare also falls into that conservative category, the defensive category, but healthcare is actually doing quite well, coming off of a real rough time last year. And then lastly, we'll just take a look at non-U.S. versus the U.S. Top line is your Europe, Australia, and the Far East Index versus the S&P. You can see it is outperforming the S&P so far on a year-to-date basis, as is emerging markets, actually to a notably greater extent. So this makes sense to me. I've talked a lot over the last year of the relative underperformance of non-U.S. versus U.S. We should expect at some point some reversion to the mean. And when you track economic periods like the one we appear to be entering now, it's not unusual to experience a period of non-U.S. outperformance of U.S. That would bode well for all of our portfolios. I don't think we have a single one that doesn't have a fair amount of non-U.S. exposure in it. So folks, I will leave it there. Thank you as always for watching and listening, and look within the next couple of days for my weekend update. Take care. Bye-bye.